Welcome back for the afternoon session of day one of our Canadian Fixed Income Conference. Over the next couple of hours, we'll hear from leading economists about the trends they're observing and their expectations for the near and long term. Financial executives from leading issuers will discuss their funding programs. And we have keynote interviews with people like Vincent Delisle of the Caisse de dépôt at Placement de Quebec, and Aldo Romani of the European Investment Bank, and lots more. We'll get started with the economic discussion, which is led by my colleague in Ottawa, Shelley Hagan.
Thanks for joining us. I'm Shelley Hagan. I cover the Canadian economy for Bloomberg News based in Ottawa. We have three great economists for our panel today. We have Stéphane Marion, Chief Economist at National Bank of Canada, Beata Caranci, Chief Economist at Toronto Dominion Bank, and Milan Mulrain, Chief Economist at Ontario Teachers Pension Plan. So I'd like to start off with all three of you, if you could give me your outlook for Canadian growth this year and how Canada factors into the rest of global growth in the G7 countries. And Milan, would you like to start?
Yeah, no, thanks a lot. Thanks for having me. I'm really excited about this discussion. I think when I think of the Canadian outlook over the next year, I would set aside the disappointment that we had in Q2 growth and think that things are likely to be fairly constructive in the sense that what happened in Q2 was a blip, and going forward, there are enough tailwinds for Canadian growth that would sustain that strong burst of momentum that we had prior to Q2 well into the next year or so. So fairly constructive environment for the Canadian economy, strong domestic demand, favorable external conditions with strong US and global demand and commodity prices providing a reasonable boost for overall economic activity. So I wouldn't get into the numbers, but still fairly strong backdrop. My key concern will be inflation. I do think that while Canada will regain the output loss during the downturn over the next quarter or two, it will take some time for us to recoup and get back to the slack that would have been generated. So we wouldn't close the output gap for some time. But even so, there's still likely to be an upwards pickup in inflation over the next few years. And we do think that the inflation is likely to be a bit more persistent. So strong growth, inflation starting to become a bit noisier than it otherwise would have been.
Were you expecting Canada to recover the output loss from the pandemic by the end of this year as well?
Yeah, I think with Canada, we'll be a little bit more delayed. And when we look at the forecast itself, we're expecting about 4.5% for next year and just under 3% the following year. Now, I agree with Milan that we're going to see some good numbers coming through. However, the forecast is highly dependent on our side on two key components. One is that the consumer side carries that growth forward. And the other one is that the inventory rebuild adds substantially to output as we go into next year in particular. And those are the two components that gets Canada, back to where it was and beyond in terms of closing the output gap. Similar to Milan, we think that's a next year story, which is where the Bank of Canada would hike once you start to tighten up your economy and move into an excess demand position, but not before then. In terms of Canada and the global context, I think we're about middle of the pack. The U.S. has been phenomenal in terms of its investment growth. And so the running speed of its economy has not been adjusted downward, meaning potential growth. So we think the U.S. is probably most likely to close their output gap first. Then you'll look to some European economies like Germany and France, and Canada will be in that pack. And then you have others like the UK that will be closing their output gap ahead of Canada, but for all the wrong reasons, that they've had their potential growth marked down because of very poor investment growth related to what's happening, not just with the pandemic, but we're kind of forgetting that they also exited the European Union, and that had substantial investment and trade impacts. So if I were rank order, I'd put US, Canada in the mix with a couple of economies in Europe, and then the UK last.
So, Stéphane, we do have the Bank of Canada expecting the output gap to close the second half of next year. Are you thinking the risks lie more to the upside or downside for that?
Well, that's an interesting question because you can look at the output gap, but at the same time, just to look at Canada's ranking in the world, if you look in nominal terms, we'll be outgrowing the rest of the G7 because, yes, real GDP is not there yet, but nominal GDP is super strong on the back of high commodity prices. So under these circumstances, Shelley, it's very hard from a Bank of Canada standpoint just to know how do you modulate for this surging terms of trade that have been quite beneficial to the economy. So I would think that, it's the script looks like, yes, it could close next year, but the labor market gap is not that bad, that large either, Shelley. So I would think that it makes sense right now to think that the output gap would be closed sometime next year, probably middle of the year, but it could very much come sooner depending on how the global economy and the global supply chain evolves.
So if it could close sooner, I know, Beata, you said the U.S. actually looks like it would grow faster than Canada. What does this mean for the Bank of Canada and in terms of its pace of tightening versus the U.S.?
Yeah, so I think, so this is an interesting question, Shelley, because while the U.S. has recovered more of its GDP because Canada had that contraction in the second quarter, which was self-inflicted, right? That was because we were doing lockdowns to contain the virus, and the U.S., just kind of powered through everything. So they've had more continuous growth. The central bank positions have actually been somewhat oppositional, that the Federal Reserve has been far more dovish than I would say the Bank of Canada. So the Bank of Canada has already started to slow down its pace of asset purchases for months now. And the Federal Reserve has yet to even lay out their plan there. And the market speculation is that's going to be a November, December story when that information becomes known. So we think that the Bank of Canada and the Federal Reserve will raise rates around the same time, which for us is towards the fourth quarter. However, it's possible that the Bank of Canada can go ahead of the Federal Reserve for the reasons that Stefan had mentioned, that the labor market performance in Canada has actually been better than what we've seen in the U.S. We do have, more in terms of nominal price pressures coming through in Canada. And so they're going to have to balance off these factors. And so it's possible that we could see a little bit of a lead on the Bank of Canada relative to the Federal Reserve. But if so, I would say just by a quarter.
Okay, so it doesn't sound like it would be too much of a difference between the two, too much time between then. Millen, what do you think about that timing, and what are your concerns around inflation and how persistent it may be? Because we have heard policymakers globally talking about it transitory, but we've now had 5 straight readings in Canada where inflation's been above 3%.
Yeah, no, I think, Shelley, that's the key question, and that's going to be the central theme around which a policy response will be calibrated by these central banks. My own view is that inflation would be more persistent than central banks are giving it credit for, and they'll probably have a bit more inflation than they need. Therein lie the rub for central banks. They don't want to tighten prematurely because that's the mistake the central banks have made in the past, and for them it becomes a bit more problematic to deal with that kind of disinflationary impulse than to deal with an inflation that you can control. But in my view, I think I agree with Beat in the ordering that the Bank of Canada will show a bit more fidelity to its inflation target than the Fed, but I see them as moving more in 2023 than 2022. In as far as we do have them going, it's likely to be gradual. So in a sense, central banks will wait, as some will say, until they see the whites of inflation eyes and then start moving. That is, they'll likely stay behind the inflation curve for fear of making that policy error of tightening too soon. But in so doing, it probably will catalyze a bigger rise in inflation, a faster rise in inflation, and so they'll have to catch up on the back end. And the difficulty will be ensuring that they calibrate policy to land that plane well, avoiding that policy error on the other side. So in my view, I think they will wait until later, but they will probably be more aggressive then.
So when do you think the Bank of Canada would first hike versus when you think they should hike?
Have have them hiking in 2023, around the mid 2023, have one hike by then, and then the Fed following thereafter. If one were to think from a traditional policy response point of view, with the output gap closing and possibly closing maybe late 2022, early 2023, then you would start lift off just before, given the confidence of that output gap closing, and gradually withdraw stimulus. I do think, because of my view that they want to go later, want to ensure that the self-sustaining recovery takes shape and that output gap closes, I think they would go on or about the time that or after, just after the output gap closes, which gets them to 2023. But Standard Taylor rule or otherwise would have said they would move in 2022, both the Fed and the Bank of Canada.
And Stefan, what are your predictions and
I think a lot
around that?
Yeah, because I think it's very difficult to measure, to have certainty about what the potential GDP is and spare capacity, therefore the output gap. So I think it's hard to have more than 55% probability on your baseline forecast currently, and that's true for both for us and for the central bank. So again, it's a baseline scenario, and all depends what probabilities you put on that scenario, Shelley. Because from an inflation standpoint, is it transition or is it temporary, transitory, more structural? I think that, yes, there are elements that suggest it's transitory, the global supply chain. Yes, there's a base effect. But at the same time, we have labor shortages. We have 200,000 people leaving the labor force to retire every year now in Canada. And I think this is just exacerbating some of the pressures that we're seeing. Add to that, Shelley, the impact of carbon taxes that will hit the Canadian economy. So you're talking a potential upside on inflation. So right now, as we speak, inflation is on a 2% trend if you account for the discrepancies caused by the pandemic. But make no mistake, over the past 3 months, headline inflation is running at 4.9% annualized. That's the last 3 months. There's no base effect in that, really. CPI trim running at 4.4%, and median CPI running at 3.2%. So we'll need to keep a close eye on that, because these are numbers that could surprise the Bank of Canada.
Yeah, certainly. We'll have to watch these inflation readings pretty closely. And something that's in the last CPI reading that actually showed a lot of inflation is the housing market and rent prices. What, Beata, do you think is the outlook for the housing market, single-family homes, and then rentals, which we've now seen starting to heat up?
Mm-hmm. Well, Canada continues to suffer from a supply shortage. So we continue to see the demand of house purchases being quite high, especially into the detached market, as the millennials fight it out with the boomer generations on that detached market. And so, this is not something that's going to alleviate in any fast order. Now, we did see out of the platforms from the election under the Liberals and the NDP, as well as the Conservatives, that there was a push towards adding more supply in the market. However, this is not instantaneous. It takes several years, and it requires coordination as well with either provincial or municipal level governments. And so it's not going to alleviate itself in short order. In the meantime, we also saw from that Liberal platform that there are measures in there that are likely going to stoke demand for first-time buyers through things like having, a tax-free account that you can withdraw up to $40,000, rent-to-own measures. These are all good on their surface. But if the demand side is reacting ahead of the supply side, it gives you one direction on where prices are going to go. You actually could run the risk of eroding affordability. So from our perspective, even though sales have come down since about March, relative to that really exuberant buying, they're basically returning to the peak levels that we had prior to the crisis. And the supply side is not showing much movement relative to sales. So we do think that we're going to see a persistent in price pressures, not double digit like we're seeing today, because the affordability is just eroding too quickly. But it's hard to build a case that you're going to see any sort of price declines. And certainly the detached market is where the interest predominantly lies. A lot of sales has been happening in the condo market now because of the affordability issue. But the detached market still drives a lot of those outcomes in terms of how the market oscillates between the condo demand and the detached market. When the detached gets too expensive, people switch to condos. It pulls up the price of condos, and then you switch back to detached. So we're in a bit of a cycle there. The only thing that really gets you out of this cycle, as we've seen in the past, are, unfortunately, recessions that cause unemployment rates to rise. And so we don't want to be in that situation, and we're not. So I think we just got to take it as it is and try to get that supply side responding as quickly as possible.
Yeah, it's the resilient Canadian housing market. Well, Stefan, I know you've done a lot of research on immigration and looked into this a lot. And that's something that, even though we saw a big drop in immigration, we saw continued strength in the housing market. Now that international travel's come back, we're going to be, the government's targeted high immigration rates. What impact do you believe that's going to have on the labor force and the housing market?
It's amazing. Last year, Shelley, we had, to this day, we have great activity in the housing market. But last year was with household formation, according to just published data by StatCan, shows that there was an increase of 27,000 households last year, which was the weakest. It's 87% below the 2019 level. So we had, super red hot activity in the housing market, but we had very little household formation to show against that. So that suggests that there were speculative forces that might have been at play this year. And I would be concerned if that were to remain the case for another year with limited immigration. But fortunately, as of June, we saw a significant rebound in permanent immigration and close to normal, actually above the 5-year average. So it does suggest that we're looking for a rebound in household formation going into the second half of this year and next year. So I would agree with Beata that, yes, activity will normalize, but we're not looking at a collapse if the immigration flows are back on trend for in the next few quarters. So not overly concerned about the residential market.
And Milan, what are you thinking will be the housing market outlook?
Yeah, no, I wouldn't depart too much from what Beata and Stefan has said. I said they both made some excellent points. I do think both from a supply side, that would take, as Beata correctly said, that would take some time for supply to come online to alleviate the pressure. Demand is likely to be solid, not only from an immigration point of view, but from a domestic point of view, with financial condition and mortgage rate still being as low as they are. That will provide, and the economy doing as well as we all anticipate over the next year or two, that would provide a strong source of demand. So demand will continue to be quite strong, at least over the medium term, and it will take some time for supply to pick up, to respond in a meaningful way to alleviate the pressure. So as was said before, the direction of travel for price seem quite obvious from there. It will stay high at the very least, or continue to move higher. So I do think over the next few years, you continue to see strong buoyancy in Canadian housing market and home prices.
And do you think we'll continue to see that strength with the Delta variant that we are seeing globally? It's caused more of a slowdown in the US. How do you think that's going to impact Canada?
Yeah, no, I think that's a great question. We've seen housing activity in the U.S. Take a bit of a hit. I do think that's likely to be temporary. Similarly for Canada, the Delta variant hasn't been as consequential as it has been in the U.S. so far. In Canada, outside of the supply bottlenecks that we've seen that affected growth in Q2, I think it's likely to be less of an impact on Canadian housing. In fact, the fact that our social distancing continued for some time until recently. It's now we're beginning to see the housing market. I think it would be in a month or two that we are going to see that rebound in Canadian housing activity. So I don't think the Delta variant, if anything, would only be probably a blip on Canadian housing activity.
And Stefan and Beata, what do you think the risk of the Delta variant has on the economic outlook? Have you had to cut any of your forecasts because of it or downgrade them?
Actually, we did for the fourth quarter, and a slight impact at the third quarter, just because the Delta variant is impacting the global supply chain. So the products we need is, it's not coming to market, and we saw big declines in productions of autos, for example, in our country. So yes, we've nudged down our growth forecast for the fourth quarter, but for the rest of the outlook, Shelley, we're one of the most vaccinated population in the world, and so far we've navigated the Delta variant relatively smoothly. We have half the cases that we had in the previous two waves. So under these circumstances, I don't expect widespread economic shutdowns like the ones we suffered in the two previous waves. So I think we're relatively well positioned, and hence our view that we're looking at for a 5-cent appreciation of the Canadian dollar in the coming quarters to reflect that relative outperformance of the Canadian economy if we're right with our forecast.
Yeah, and I would say similar
to, you have to downgrade your outlook?
Yeah, very similar to Stefan. I think we had to take on board some of the slowing momentum that we were seeing, particularly related to supply side factors. I think there's a lot of demand for autos out there, but there's just none to be had. And so you're seeing that coming through on the consumer profiles in Canada, as well as very strongly in the US as well. So that we took on board. Beyond that, I would say, one of the concerns I have about Canada, and I agree with Stefan, we do have one of the highest vax rates in the world, is certainly relative to our advanced economy peers. However, Canada has far more sensitivity to shutting down the economy with lower levels of cases and much lower levels of hospitalizations than we've seen in Europe, obviously the US, but Europe in particular, even when we looked at Israel as one of these leader countries and what they were doing. So we haven't built in a shutdown into our forecast. What we have built in is no further progress in reopening. So for the fourth quarter, we do not build in the possibility that, say, Ontario will go to stage 4, because we know that there's a much more cautious stance here when we see a certain level of cases or hospitalizations relative to other countries. And so because of that, there's potentially upside to the forecast should that not turn out to be the case. But if history is any guide, we do expect Canada to show a lot more conservatism here as we go through this fall and winter months, irrespective of the vax rates.
Yes, that is a key difference with Canada and the US, is they don't have the hospital capacity, so they have to shut down. And I know you wrote a piece on vaccine passports and how that could play into economic growth. And it looks like now Ontario and a bunch of provinces have implemented those vaccine passports, so that should be good for growth.
Yeah, that's our hope. Like our view is you got to do everything, use every tool possible to see if you can avoid the shutdowns, especially when you have a lower threshold on hospitalization than other countries. And so we were a proponent of vaccine passports for that reason, in an attempt to protect businesses from having to shut down. We know there's a lot of political and ideological push against these, but from an economic stance, just purely being agnostic on this, we would just prefer that businesses stay open and we use every tool possible. We don't keep resorting to the pre-vaccine tools that we had. We have many more now at our disposal.
And I know we have just a few seconds left, so I just want to ask you guys really quickly, a yes or no, if you believe the Bank of Canada will taper to $1 billion in October at the next meeting. Millen, are you expecting that?
Yes.
Stefan?
I do, yes.
And Beata?
It's unanimous, yes.
All right. It sounds like that's the consensus. Well, thank you all so much for joining.
With me, Don Delisle. He's the Assistant Deputy Minister of Manitoba's Treasury Division. And I also have Rodney Balkwill. He's the Executive Director of the Treasury Management Branch in Saskatchewan's Ministry of Finance. So I'd like to start off with a broad question. Don, if you could start off and kind of give me your fiscal outlook.
Sure. No, I'll be pleased to. So just last week, both our 2021 public accounts as well as our first quarter for the current fiscal year came out. Absolutely no surprises. Basically, both right on forecast. The first quarter came in again right on where budget was, about a $1.5 billion deficit. Again. where expected. There is $1.2 billion in pandemic relief in that budget. So again, no surprises. I think we're fairly optimistic going forward. The independent economists that we use have been continually upgrading our forecast. For 21, they have a 10.7% increase nominal and 5.7% real. And for next year, 5.1% nominal and just 3.7% real. So getting pretty close to full recovery back after the COVID pandemic. As well, some of our key economic indicators are showing some very good strength. We have the lowest unemployment rate in the country at 5.7%. Retail sales are up almost 21%. Manufacturing is up about 14.5%. And exports are increasing very well as well. The other benefit we've always had is we're one of the more diversified, most diversified economies in the country, with no more than 10% in any sector of the economy. So we were also in a strong position going into the pandemic, with in 2020 having balanced the budget for the first time in over a decade, and unfortunately for this current government, kind of got lost in the pandemic. So this government's fiscally focused, and on a go-forward basis, they've again committed to balancing the budget in 8 years. Keep in mind, they said that when they came in 2016, and they did it in half that time, in 4 years, to balance in 2020. So we know that's where their commitment will be. So going forward, we're pretty optimistic. We're doing pretty good right now with the fourth wave, touch wood. So all in all, optimism at the moment, all things considered.
Okay. And Rodney, what is your outlook? Are you pretty optimistic as well, even though we do have this fourth wave and the Delta variant causing some restrictions across provinces?
Yes, we're still fairly optimistic. Obviously, the fourth wave, it is impacting Saskatchewan harder than other provinces, and so there's some pessimism there. From a fiscal perspective, we did build in quite a bit of expenditure into this budget for 21-22. So we are forecasting a $2.6 billion deficit. And our recent update in August, our Q1 update, did indicate that we're still on track for that. And while we are seeing improvement in taxation and royalty revenues, we've also set money aside for agriculture supports, as in this province and through much of Western Canada, there has been dry growing conditions. And so we're anticipating support payments to both crop and livestock producers. So our optimism from an economy recovering perspective is still there, although we do have some downside from the crop aspect of things. So that is going to keep our deficit as expected, but it doesn't diminish our expectation to get back to balance in the next 6 years. It should be just a blip in the road, and then carry on as like most provinces, we are seeing better economic recovery and better revenue recovery than we had anticipated.
And you're talking about some issues in the crops. I'm curious, from an economic perspective, I've been hearing a lot about supply chain issues in agriculture and other areas. Is that something that is weighing on in your province as well?
Supply chain issues are always critical for agriculture and all the other commodities that we produce in this province. Through the pandemic, they weren't really impacted to the same extent as others, because they're very hands-off, as you can imagine. Trains crossing borders, bulk products going on ships. In fact, we saw exports increase during the pandemic for Saskatchewan as opposed to decrease, as those supply chains held up. These days with agriculture, the main supply chain issue was actually forest fires that were happening in the west, further west in British Columbia, which impacted rail shipments. And continue to, and then also some broader impacts on the shipping side of things has impacted movement of grains. So yeah, something we're very concerned about and watching, but so far has not impacted to to the same extent as perhaps some other areas of the economy.
Okay. Yeah, those forest fires were pretty bad this summer out west, and even Ontario had some. Could you guys tell me what are your borrowing needs for the rest of this year? Don?
Sure. Our borrowing program is 5.7 billion CAD this year. We're at the moment about 50% through our current year's requirements, and with the expectation of borrowing that 5.7 billion, we will be pre-funded going into the next fiscal year by about $1.5 million. We are attempting to stay very liquid these days because of the uncertainty with respect to COVID, the pandemic, and whether that's going to have any effect on markets. It's just we're not quite sure what's going to happen potentially with expenditures. So again, we're going to continue to stay conservative and very liquid. We're going to do that in both domestic and international markets. Our main focus is the domestic market. We look at to do benchmarks, but in 5, 10s, and longs, specifically in 10s and longs, and we will look at international opportunities both in the U.S. as well as other currencies, because we have both a U.S. dollar registration statement with the SEC, as well as an EMTN program and an Aussie dollar program in place. So we're quite optimistic about getting the completed full completion of the borrowing this year.
Are there any international markets you think are most likely? Is it the U.S. dollar market or the Aussie?
The U.S. dollar bond market is a key strategic market for ourselves. We attempt to go there once a year as benchmark. We certainly not lost on us that it's been significantly over a year because of the pandemic getting down there, but that is a market we'd like to get a benchmark on at least once a year. So we are watching that market very closely. And the rest of the markets, Aussie dollar, one-offs off our EMTN, because we were in many currencies, sterling, Swiss, New Zealand dollars, NOKI, I'll swap back to Canadian dollars. We have to make sure the arbitrage is working and that it's cost competitive with what we can do domestically.
And Rodney, what are Saskatchewan's borrowing needs this year?
We have a $4.6 billion borrowing plan, and like Don, we're pretty much on pace, almost halfway through. Borrowing completely in the domestic market so far, but we do have plans to access the international markets to a larger extent than we have in the past. So last year we re-entered foreign markets by issuing a small amount in euros, and that was the first foray into the international market since 2003. So we're stepping back in slowly, but this year we would anticipate by the end of our fiscal year in March that we could be into the U.S. dollar markets and possibly a euro trade as well. We're open to all currencies, but those are probably the first steps in the near term. But it will depend on pricing. We're not a frequent issuer, obviously, in those markets, but and we don't actually have to be there unless the pricing makes it work. So we'll be watching to make sure we're picking up maybe 5 or 10 basis points in cost savings, in addition to all the other benefits that expanding our investor base brings to us.
And did you say that would be in March sometime you're going to look at that?
Well, we think we can maybe get it done by the end of March. So I would say the earliest, given the way documentation works and things are all working a little bit slowly these days, if markets are on the right spot, we could be looking at first 3 months of 2022.
Okay. And what is it about international markets that are looking more attractive right now?
Well, for us, not being in the international markets means moving into those markets opens up a whole new level of investor base, investors to purchase our debt. So the province's debt. So in Canada, it's a very deep market. It's been very good for funding. But from a risk perspective, it's a great idea to broaden out into the broader world markets that buy in obviously other currencies than the Canadian dollar. So that can, the end result, of course, is potentially lower borrowing costs and more avenues for funding should difficulties arise like we witnessed last March through the pandemic. So it just really elevates the game and in terms of the sophistication of the investor base that we can bring to bear.
And I'd like to talk to you both about any plans to issue green bonds. Maybe if you could talk about anything, if you have historically, and why or why not. Don?
Certainly. To be honest, we're in just the preliminary stages of having internal conversations on an ESG program. We are working with the Department of Conservation and Climate on this initiative. I can't emphasize enough that it is in the preliminary stage. The challenge for us is going to be able to identify enough projects to sustain a formal ESG program and the work that's going to go into that with respect to having the website, getting it rated, et cetera. So that is, again, in the in initial stages, and we'll see how that progresses over the next year or so. The other thing probably should be noted is that we do all the borrowing for Manitoba Hydro. Manitoba Hydro is the sole electrical producer in the province, and they are one of North America's clean energy providers, with over 97% of their electricity generated through hydro. 2.5%, I think, is in wind, and less than about 0.1% in thermal. So about a third of their generation is exported to the U.S. and other provinces, and that is helping them reduce their carbon footprint. For example, the U.S. exporters are almost all thermal.
Is there a lot of demand for you to issue green bonds? Why would you consider that?
There is definitely a demand. There is an investor that I've been talking over the last number of years with that haven't asked whether we're going to be doing it. I think, again, the biggest challenge for us is to identify projects. Sewer and water, public transportation is all at the municipal level. So for us, I think if Hydro had been starting the big projects they had done, the generation station kiosk, as well as the Bipole 3, the HVDC transmission line that they just completed, and we're starting that instead of completing it, I think it would have been front and center for us putting it into a program.
And Rod, does Saskatchewan have any plans for a green bond issuance in the future? Is that something you're looking at, some kind of ESG bond program?
Well, it's an interesting area, and we do have an active file, especially on the green side of things. Saskatchewan is historically a carbon-intensive province. Its industries are resource extraction and agriculture, and its power plants have been historically carbon-fueled. But we have committed to the federal government to eliminate all coal power generation by 2027, and that will be replaced by other transitional fuels, but also increased hydro imports and the possibility for small modular reactors down the road. Now, to the extent that those could be green projects is open to debate. Certainly transmission lines bringing in hydropower could be lumped into that. But we're probably looking at it more from a transition transition perspective. And there is an increase in the green area, the green arena for transition type funding, which would be probably where Saskatchewan would line up. We do have solar and wind farms. The projects aren't huge, but certainly there could be some funding that way as well. The ESG side is a new area. Of course, government is very active in social programs. How that fits into funding is a little bit newer area for us, and we're starting to look at that as well to see if there are opportunities there.
And will there be any challenges that you're worried about on the revenue side for the government, as we do have a push towards reducing carbon emissions, and we do have the new government that is very aware of that? Rodney?
Well, certainly, it's a concern. There is oil produced in this province, and from a pricing perspective, that can impact revenues, impact demand, impact the price of these resources. I won't comment on what's going on I wouldn't be able to comment on what's going on between at the political level in terms of addressing those issues. But yeah, in an economy like this, there's some things that probably need to be addressed in terms of making sure it's a smooth a transition as possibly can be expected.
And Don, does that have impacts as well as when your province forecasts revenues and so forth?
No, again, as I'd mentioned earlier, our oil and gas in Manitoba is very, very small. All generation of power here basically is electrical, or is hydro for electricity. And with respect to the diversified economy we have, they're really not expecting any kind of significant effects on our revenue base at all.
Okay. And I just have a little bit of time left, so I did want to ask you, I know you both said you're pretty optimistic on the outlook looking forward, but is there something that you're a little concerned about or that's keeping you up at night as we do enter the fourth wave? We don't know how that may affect things. Don?
Yeah, right at the moment, we're pretty fortunate. We've got one of the lowest infection rates in the country on a per 100,000 basis. If you were to take a look at the Johns Hopkins data, I think we're fourth lowest. Only Newfoundland, PEI, and Nova Scotia are lower than us at the moment. We did get hit fairly hard with the second and third waves. But we have one of the highest vaccination rates. Over 80% of our eligible citizens are double vaxxed. We were one of the first provinces to put in a mask mandate for all indoor public places. And we do have a vaccination passport for things such as dining, indoor sports, for example, Winnipeg Jets, et cetera. And so as a result, we're hoping that these measures are going to continue to keep the rates down and allow to keep businesses open. This is fully supported by the chambers of commerce and other business communities, so that we can keep businesses open. So again, as optimistic as we can be in this type of environment.
Yeah, I do remember hearing when Manitoba was in, I think, a very strict lockdown, maybe earlier this year or late last year. Yeah. So it sounds like things have opened up.
Yeah, that was during the third wave. Yes, they have opened up. And again, some of the measures put in place, as I just mentioned, I think are helping significantly with that.
Okay. And Rod, what does the outlook look like for Saskatchewan? How are they dealing with this fourth wave?
Well, as we mentioned on the opening, the fourth wave is hitting us harder. And so, the optimism is tempered by that. New restrictions are in place in terms of vaccine mandates and gatherings. So there is some and mask mandates, of course. So that has the potential to slow things down a bit. At risk of being definitely not sounding optimistic. It's a difficult thing to get through. So, but the economy seemed to have figured out from some perspectives how to operate in these environments. We will expect to see, the higher healthcare costs coming as a result of this. I think that hasn't been announced yet. But those are things that we would be on the lookout for sure. And then for us globally, it's a big question about, does something impact the global economy, as we are a very outward-looking province economically. And so from a commodity perspective, or a trade perspective, those things are some of the bigger risks. So, but cautiously optimistic.
Okay. Well, it looks like we're just about out of time, but thank you so much, Don and Rod.
Well, thank you both to Bloomberg and National as the major sponsor. Really appreciate these opportunities.
And I have with me Lowell Epp, the Assistant Deputy Minister of Treasury and Risk Management in Alberta, and Mike Manning, the Executive Director and Chief Investment Officer of Capital Markets at Ontario Financing Authority. So I'd like you both to start off and give your fiscal outlook. If you could start off, Lowell.
Sure. Our fiscal outlook certainly improved in the first quarter. In budget, we forecast a deficit of $18.2 billion due to higher employment levels, but particularly higher oil price levels. We are now forecasting a budget deficit of $7.8 billion. The employment has, like I said, improved significantly. We're almost back to the same number of jobs in Alberta as we had pre-pandemic. They're different jobs in many cases, but we've achieved that employment level.
Yeah, we certainly have a recovery in the labor market in Canada. It's recovered a lot over the summer months as we've reopened. Mike, can you give an overview of your fiscal outlook?
Yeah, I'd just like to point out that on Friday of last week, September 24th, Ontario released its 2020-21 public accounts. And it reported a deficit for 2020-21 of $16.4 billion. Remarkably, that was a $22.1 billion lower number than we had in our 2020 budget. This resulted from stronger revenue growth and led by higher than anticipated corporate and personal income taxes. Due in part to the overwhelming COVID-19 supports provided by all levels of government, as well as lower than projected expenses. We will be taking a measured approach, and we'll be in our fall economic statement, which is our mid-year report. We'll be taking a fresh look at our deficit numbers, as well as our borrowing requirements, for the remainder of the fiscal year. Prior to that, we did have in our Q1 finances, which came out in August, we did have a lower deficit number for the current fiscal year of $32.4 billion, and that compares to 33.1, which was the budget estimate at the start of the year. So it seems that our fiscal situation is improving somewhat. So sort of in line with what we're seeing maybe with some of the other provinces as well.
And Mike, can you go in then a little bit to your borrowing program and what your needs are for the rest of this year?
Sure. So our current borrowing requirement is $53 billion, and that number was derived from our Q1 finances. Factoring in that we borrowed about $24.6 billion already, the remaining borrowing requirement for the current fiscal year is about $28.4 billion. Just in terms of context, the $53 billion requirement is down from the $59.8 billion that we borrowed last year.
Okay. And Lowell, what are Alberta's borrowing needs for the rest of this year?
So we started the year with a borrowing requirement of $24 billion, and that's been reduced to $17.6 billion. We've raised approximately $7.5 billion this year so far, including $4.2 billion in the bond market and about $3 billion in the money market through increased short-term debt. That leaves us with about $10 billion left to borrow this year, which we expect to do in the bond markets.
And what's been the appetite for that in terms of domestically, and have you issued any internationally, or will you be?
We haven't issued anything internationally, mostly because we haven't borrowed as much as we thought we would in the first half of the year. So the appetite domestically is strong. With higher oil prices, our spreads have been coming in consistently. So right now, the appetite for Alberta bonds seems to be very, very good.
And Mike, can you speak to the demand for your bonds, how it's been, and whether you've done any international or U.S. dollar issuance?
Sure. I would say that the demand for our bonds has been very strong. It's sort of been anchored in the domestic market, where so far we've done 22 domestic deals, kind of roughly to the midpoint of the year. That compares with the record issuance last year of about 38 domestic deals, and the volumes are quite good as well. So domestically, the market's been very strong. It's provided good duration in terms of being able to do 10-year and 30-year issuance. Internationally, we've also been relatively active, maybe a bit less so than the previous year. We've done a $3 billion US dollar 5-year deal. We did back in April. We've done a $1 billion euro. We've done 250 million Swiss francs and a small 35 million Australian dollar transaction. So we've been active, a bit less so than last year, but still the international component has been about 23% of our borrowing program so far.
Okay. And Ontario, it's been one of the largest issuers of green bonds here in Canada. And there were reports that you were considering to add a sustainable bond program. Can you talk about why it would be necessary to add a second bond program, a second ESG bond program?
Sure. Maybe what I'll do is maybe talk first a little bit about our green bond program. So we've been a regular issuer of green bonds since 2014. Over the years, Ontario has issued about 10.75 billion of green bonds and is the largest and most regular issuer of Canadian dollar green bonds worldwide. We benefit from having an infrastructure spending program to support our green bond program. For example, spending on transit is estimated to be almost $54 billion over the next 10 years. So that provides a good pipeline of projects that we can use for issuing green bonds. I'll just mention we've been issuing, in recent years, we've been issuing 2 green bonds every year. Our last green bond was a $2.75 billion offering, which we did on July 27th. It was our 10th green bond and the largest ever offering of a Canadian dollar green bond. And we expect to offer our next green bond later this fiscal year. We haven't determined an actual date yet, but typically it'll be the fall or potentially early in the new calendar year. We put together our green bond program, as I said, back in 2014. And one of the first things that we worked on in developing the program was a green bond framework. So our green bond framework is getting a little bit stale. So we're, as you mentioned, we're in the process of taking a look at that framework. And sustainability is something we're going to look at. We have no plans to issue social bonds at this point in time. But we think it's, given the fact we're looking at an update, we think to expand it to sustainability just makes a lot of sense.
Okay. And do you have any timeline for that?
It's a fairly intensive process. We've reached out to some of our dealers, and we've got feedback on our framework, so we are working on it. It's a fairly comprehensive project, so I suspect that we'll have it done by the end of the fiscal year.
Okay. And Lowell, can you talk about whether Alberta may be issuing any green bonds in the future and why or why not?
So far, we haven't set up a framework for green bonds. Our attention has been elsewhere. We certainly monitor the market and recognize it's an important market, but right now we really don't see that it is worth the effort for the savings in borrowing costs that we estimate. The other thing is that while Mike has many projects to issue green bonds against, we have much fewer projects to issue green bonds against. The government is more focused on encouraging innovation from the private sector.
Okay. And so what kind of demand would that mean? Like what kind of, is that mainly domestic demand for those kind of projects? Or could you talk about what kind of projects the government's interested in?
Well, what the government is interested in the ESG space is helping various energy companies meet their targets and develop technology. We have a carbon tax program in Alberta, separate from the Canadian carbon tax. And that program, the revenue from that is, much of it is invested in technology or development for the oil sands and energy sector.
Okay. And I did want to ask you, I guess, Lowell, if you want to start off, what are your thoughts on the economic outlook? And then, of course, how that may impact issuance. Alberta has been in the middle of a fourth wave. It's been pretty tough. And so we don't know yet what will happen as kids have gone back to school. We may find out in a few weeks how that may affect the economy and further restrictions. So I wanted to get your thoughts on that.
So it's kind of early to tell what the economic impact has been. So far, the government has not had a very restrictive lockdown, as restrictive as some are calling for. This has allowed more businesses to stay open and continue to produce in this environment. What we see, there's no doubt that fourth wave has hit Alberta pretty hard, and there's no doubt. But much of our employment, much of our industry is not reliant on the retail sector, and so those industries tend to do better in the lockdown environment than others.
Okay. And Mike, can you talk about your outlook?
Yeah, I think the outlook it's certainly improved. We did our budget back in March of this year. We were looking at a real GDP growth rate of around 4%, which was quite conservative, I think, at that point in time. And later on, when we did our Q1 finances, that growth estimate was upgraded to about 5%. So it is definitely been improving. But I'd have to say that the level of uncertainty is still high. And, there may be some further impact from the fourth wave. But as shown by our public accounts, the fiscal situation appears to be very, very resilient. So I think that's where I take some positive, have a relatively positive outlook on that.
Mm-hmm. And we all, high vaccination rates in Canada relative to other countries. So with the vaccine passports, maybe there will be fewer restrictions. And I do have time for one or two more questions. Mike, I did want to ask you, as Ontario goes ahead with a path to reduce the budget deficit, the volume of debt outstanding has been significantly bigger than before the pandemic. So in that context, do you have plans to issue in new currencies or durations?
I don't really believe so. I think we are focusing on the domestic market. The domestic market tends to provide slightly more cost-effective debt than when we go offshore. So we've really been focusing on that. The nice thing about the domestic market is also provides duration, longer-term debt that we would get, for example, in the international markets typically. So I think we'll continue to focus on that. Also, it's efficient in the sense that it doesn't have to be swapped back to Canadian dollars, which we do with most of our foreign issuance. So I think we will continue to focus on that. But at the same time, we are regular issuers in international markets as well. Typically in U.S. dollars, we tend to do roughly 3 to 4 benchmark U.S. dollar deals per year. Our last U.S. dollar deal was a $3 billion 5-year deal we did back in April. So I would think that we will be looking to do at least one more U.S. dollar deal between now and the end of the year. The euro market is also a core market for us. We've done one deal there already, but we'll be looking there. And the other currencies, we're monitoring a host of currencies. If we do see arbitrage, or we do see a good issuing opportunity, we would definitely be taking advantage of that. So I think we're going to be sort of just watching all markets, typically the way we've been doing in the last several years.
Okay. And Lola, I did want to ask you about how the energy market and the oil prices have affected revenue and perhaps your issuance. Of course, the oil market did get hit really hard at the height of the pandemic, but it's really recovered now, and we're seeing a big boom in prices. So how is that affecting?
It certainly has had a positive impact on revenues. Our fourth quarter update suggests that revenues are, or forecast that revenues will be 6.9 billion higher from non-renewable natural resources. It also obviously impacts employment markets and therefore income markets. Our income taxes are up a couple of billion. And so primarily the reduction in the deficit of about 10 billion is due to the higher oil prices. We're currently forecasting $65.50, and if the oil shortage that seems to be taking over the energy prices lately continues, maybe we can do better. But as Mike said, it's awful early to tell for sure. Lots of uncertainty.
So you are forecasting at least a little bit better prices in the future?
Well, we started off the year. We started off the year at 46. We went to 65.5, and we haven't changed that official forecast. The trend is our friend right now, but oil prices can shift the other way in a heartbeat. So one never knows.
Has the appreciation of the Canadian dollar been a headwind at all to your exporters?
For us, an appreciation in the dollar means, since oil and natural gas are priced in U.S. dollars, means we get fewer U.S. dollars back, or Canadian dollars back, from our U.S. dollar trades. And so actually an appreciating dollar hurts the Canadian, or appreciating Canadian currency hurts our revenues. Not as much as oil price gains have helped us, but we're actually exposed to an appreciation Canadian dollar.
Okay. So it hasn't offset completely, though, the benefits of the higher oil prices? Yeah.
Not even close.
Okay. Well, thank you both so much. I think we're just out about of time, but thank you, Lowell and Mike.
Heike Reichelt is the head of investor relations and sustainable finance at the World Bank Treasury. Thank you so much for joining us today, Heike.
Thanks for having me.
So could you explain to our audience a little bit more about your role at the World Bank?
Sure. So as you mentioned, my title is Head of Investor Relations and Sustainable Finance. So I lead a team, and our role is to engage with investors who buy our bonds. We explain to them, what the World Bank does, our credit, our funding, and really we've been spending a lot of time recently talking to investors about how the World Bank uses bond proceeds for its projects and programs around the world. And we're actually responsible for several issuers. The largest is World Bank, officially called IBRD, or International Bank for Reconstruction and Development. But also recently, we became responsible for the funding program of IDA, International Development Association, which is an organization that has been around for 60 years, but only recently accessed the capital markets.
And you mentioned that the World Bank Treasury is responsible for funding programs with several issuers. Investors in the audience are more familiar with the IBRD, known as the World Bank, but the IDA is relatively new. So can you tell us a bit about the two issuers and their funding programs? What's the size and product mix for both issuers, and how will this evolve?
Okay, sure. So both issuers work towards the goals of the World Bank Group, which is to eradicate extreme poverty and boost shared prosperity. They do this in different ways and have different clients. So the World Bank, or IBRD, provides financing for middle-income countries. And the projects are health projects, education, sustainable infrastructure. And we raise funds in the capital markets, have been doing that for over 70 years. And the funding program is about, an average $50 to $60 billion a year. And the products range from very small customized transactions to very large benchmarks. The largest is around US dollars 8 billion. And the World Bank offers funding in many different currencies, like 20-something different currencies. And IDA, International Development Association, the organization that's been around 60 years, but is relatively new for the capital markets, gets funding every 3 years from its shareholders in a process that's called replenishment, so that IDA can provide grants to the lower income countries. And a few years ago in 2018, IDA, for the very first time, accessed the capital markets. So IDA leveraged its capital so that it could scale up to help meet the Sustainable Development Goals. So IDA is a relatively young issuer with a funding program last year of $10 billion equivalent, but that is growing.
Has IDA issued in CAD?
In Canadian dollars, not yet. So the currencies that IDA has raised funds in are US dollars, euros, sterling, and also Swedish kroner. IDA has not yet issued in Canadian dollars, but is looking at Canadian dollars as well as other currencies like Australian dollars, New Zealand dollars, and some Scandinavian currencies. So hopefully that will come.
And shifting over to ESG, the World Bank has been at the forefront of the shift towards ESG-focused investing in the capital markets. What do you see along those lines going forward?
Yes, that's correct. So almost 15 years ago now, the World Bank issued the very first labeled green bond. And we've really seen a shift in the capital market since then. So it catalyzed a change in behavior of issuers and also investors. Before that time, the conversations that we had investors really just revolved around the financial aspects, the terms, the interest rates, credit, of course. But now conversations go beyond that, and investors are really trying to understand how the World Bank or IBRD and IDA are using the proceeds for different projects. And I think this is evolving. Investors are asking more questions. They want to understand the environmental, social, and governance credentials of an issuer. With labels, they know what's behind the labels. They have transparency for that, but they're really looking for a much broader range of information. So I think where this will evolve is more transparency, more data. So a lot of focus on impact reporting and helping investors compare the bonds that they're buying and how they're helping towards positive impact.
And what themes have you seen the most interest in from investors?
I would say that climate is at the forefront of everybody's minds, including ours. Over the past 18 months, social themes increased also the interest because of the pandemic, interest in how we were supporting health, education, how children were affected by the pandemic in terms of their learning, for example. We issued several bonds with a gender theme, so we were engaging with investors around gender and the effect the pandemic had on women, for example. But I do think that climate is the challenge of our generation, and what we are spending a lot of time on is talking to investors about our entire balance sheet. So the World Bank issues, I mentioned that we issued the first green bond and we're continuing to issue green bonds, but we've also expanded this dialogue with investors to a more holistic approach and talking to them about our entire balance sheet. And we have used the label Sustainable Development Bonds for that. And we are currently engaging with investors to explain to them how climate is mainstreamed and integrated in everything that the World Bank finances. So I would say that the shift is going towards this holistic approach and talking to investors about different themes.
In your impact report this year merged impact reporting for green bonds together with impact reporting for sustainable development bonds. Can you explain why you made that decision?
So it's a little bit of what I was talking about. It's this holistic approach. We have green bonds and investors are interested in our mitigation activities, how we're working with countries on adaptation and resilience projects. But they're also interested in the entirety of what we do. So we published one report and we still have a section on green bonds. We have a project by project reporting and showing how we're allocating the funds through our reporting to specific projects. And we report on metrics like greenhouse gas emission reductions. But we're also including reporting on our entire portfolio, and it's slightly different. We use the Sustainable Development Goals as a framework to explain how our activities support the entirety, all 17 Sustainable Development Goals. But the reporting is a little bit different. With green bonds, it's a smaller portfolio. It's much more limited. There's 100 projects. With the Sustainable Development Goals, we have a portfolio of over 600 projects. So the reporting, we're trying to summarize it in a way that makes sense. But it's all going towards this more holistic approach.
And what other key initiatives do you see developing in the market for ESG products?
I think investors are asking more questions about the issuer. So labels are a starting point. They're interested in what's behind the label. They're interested in the approach. They expect that issuers follow the very standardized process that's published in the Green Bond Principles or the Sustainability Guidelines by ICMA, the International Capital Market Association. But they want to learn about the issuers overall, the strategy, also where the issuer is going. So they're not just taking a point in time approach, they're looking at how the issuer strategy is evolving. So I think where we're going with this is that investors are taking on a more holistic approach, and they're using different resources, different sources of information, including ESG scores, including impact reports, and data providers I think platforms that provide data like Bloomberg will play an important role in helping investors compare different products.
So let's get back to the funding program. There's a big shift going on. LIBOR will be going away, and the markets are putting plans in place to transition to new reference rates. For the US dollar, how is the conversion to SFR impacting your funding operations?
Yeah, there's a lot of acronyms there. So yes, LIBOR is going away in the capital markets. And for US dollars, the new reference rate is SOFR, the secured overnight financing rate. And our funding is, we're helping to build that market through our funding. We issued the first SOFR bond by a supranational entity, and that was in 2018. It was small, a $500 million transaction, and it was a short duration, 2 years. And that market has really grown. We then issued longer maturities, 2 years, 5 years, 7 years, and recently also a 10-year. So that market's really expanded. And other reference rates are also, building more markets. So for example, for sterling, there's SONIA. So I think that the conversion or the transition to these new reference rates is going well.
And what product innovation might we see as a result of the SOFR transition?
I think we'll see innovations more on the hedging side. So the funding, the bonds seem to be quite well established. I think we will see innovations on the hedging side.
And have you seen a shift in the core investors with the transition to SOFR?
Yes. Initially, the investors were almost exclusively banks, US banks, but that has shifted. There's asset managers, pension funds, corporates, so a broader, more diverse investor group. And for us, we've also seen some new investors who weren't purchasing World Bank bonds. They became interested in our SOFR products, and so we had them as investors and could diversify our investor base.
And has the interest rate environment shifted your duration targets, or is that driven by the asset side of the book?
So we actually hedge with floating rate. So we're not so much driven by the interest rate environment. What I will say, though, is, well, first of all, we have lengthened our duration, and it does help because on the asset side, our duration is longer. Our average duration this past fiscal year was around 8 years. And the reason we're doing that is to smooth out our refinancing. So to smooth out our refinancing. And for the investors, because of the interest rate environment, because of low interest rates, they have been moving out the curve. So indirectly, the interest rate environment has affected our funding because it's easier for us to raise longer term funding. And we do that in currencies such as euros. That's a really good market for that.
And what's the next thing in terms of investor engagement for you?
So I mentioned that we have launched this initiative to engage with investors around mainstreaming climate. So we're communicating with investors, we're explaining the World Bank's climate change action plan to them. We're talking about this approach of how we're working with countries on the whole of the economy approach. So there are 5 sectors that are responsible for over 90% of greenhouse gas emissions. So if we can work with countries and help them transform those sectors, it would make a huge difference. So we're taking this holistic approach in our work with countries. And in our engagement with investors, we're trying to explain this to them, and then also explain how, our entire portfolio, every single project goes through, has a climate angle, because we assess every project for climate risks. And then if you look at the number of projects for IBRD, over 95% of our projects have climate co-benefits, as it's called. So they have some sort of climate financing in them. And then if you aggregate that climate financing up in the entire portfolio, it's more than a third for IBRD. So this is what we're trying to talk to investors about. And then we're going to be issuing sustainable development bonds on the back of that. And we're targeting $10 billion in sustainable development bonds while we're engaging with investors on our new climate change action plan. So that's something that's new for us, and we're really excited about it.
So we're going to be running out of time soon, but was there anything else that you wanted to mention that you think would be really important for our audience to hear?
I think maybe 3 things. One is that we have to remember and take a global holistic approach. Another one is really focus on transparency and data and providing information. And there's a lot of developments around technology and AI, but we shouldn't forget the human touch, the human interpretation of data. And then finally, I would say that, we have to have the end goal in mind, which is that we want all activities to be sustainable, and, think about financing everything that really helps people and the planet.
Perfect. Thank you so much, Heike, for joining us today. We really appreciate it.
Thank you. It was a pleasure.
Hi again. I'm Derek DeCluett from Bloomberg News, and I'm very pleased to be joined today by Aldo Romani. He is the head of sustainability funding at the European Investment Bank. That's the lending arm of the European Union. And he joins us today from Luxembourg. Welcome. Thank you for joining us.
Thank you very much for the invitation. It's a pleasure to be here.
The EIB was one of the pioneers of the green bond market, going way back more than a decade now. So I'd like you to start there and talk about how that has evolved and the framework has been, an approach to green bonds from the EIB has updated and changed over time. So tell us a little bit about all of that.
Well, we inaugurated, in fact, the green bond market in 2007 with our first climate awareness bond. The background was the commitment of the European Union to fight climate change, and the Energy Action Plan that saw renewable energy and energy efficiency projects as a key to this objective. Now, the EIB was asked, in fact, to scale up its financing to these areas, and we saw an opportunity on the capital market side to get capital markets involved. And the idea from the very beginning was that it would have an interest for the market if the bank could make itself accountable, not only with regard to the objectives in terms of signed loans that the bank wanted to pursue, but also in terms of the actual deployment of the funds into the economy. As you know, there is always the delay between the signature of a loan and the actual disbursement of the loan into the economy. So we put in place an infrastructure that could provide that accountability, and this required also a fixed set of definition, a clear set of definitions to permit the bank to monitor these flows coherently over time. So this was an idea that, in fact, was a very fruitful one, because it introduced the notion that you can report on disbursements, not only on loans, that you can report by policy objective and not only by sector, as per prevailing practice. So then followed the financial crisis. But from 2013 onwards, the market got a lot of attention to this segment again because it saw the opportunities ahead. In particular, investors saw the opportunity to add an additional component to this monitoring, which is impact. What is the expected impact from the application of the funds to projects in the economy? And this triggered a series of initiatives, first of all within the Green Bond Principles, this forum of market participants that has debated these issues from the very beginning. And this eventually led to the definition of the essential features of green bonds in the market, but with a gap towards a high degree of precision with regard to what is green and what is sustainable more generally. So this triggered in 2016 the intervention of public authorities, in the first place also the European Union, that decided to reform sustainable finance towards a high degree of transparency and accountability. A number of working groups were created. The EIB was asked to participate as a technical advisor. It contributed its expertise in both capital markets and project evaluation. And the result was a piece of law last year, the so-called taxonomy regulation that entered into force last year, that is in enabling frameworks within which issuers and investors can take initiative in this field by making reference to a shared set of definitions of what is sustainable. And our strategy has adapted accordingly. We have, of course, participated in the course of time in all the initiatives of the market in this area. But the bank has very clearly, at the end of 2020, in the so-called Climate Bank Roadmap, stated that it intends on the lending side to increase the share of green finance on the total of its new operations in a year to at least 50%. It has stated that it intends to measure the results on this path by aligning the tracking methodology with the framework established by the taxonomy regulation. And this has immediate consequences for the funding side, because the funding side, so when we issue use of proceeds bonds that are linked since 2018 to this evolving legislation on sustainable finance, we are in a position, in parallel to the application of the taxonomy to the lending activities of the bank, to extend the scope of our climate and sustainability awareness bonds in a way that extends, in fact, that sheds more and more light by reference to these external criteria on what the bank is actually doing. And in fact, we have already indicated to market our plan to align our framework progressively with the EU Green Bond Standard that the European Commission announced also in form of a regulation proposal in July this year.
Sorry.
Yes, maybe additional information on this, because this has permitted us to, last year, to issue more than 10 billion euros in these two products, which was 15% of the total program funding of the year of 70 billion. This year, we have, at this moment, a share of around 18%, which gives you an idea of what on the one side, demand there is for these bonds, and also how we are responding concretely to this demand with a consistent approach on the lending side.
On the issuance side, how has your investor base evolved in recent years?
Well, clearly, sustainable investment is gaining importance all along the spectrum of potential investors. And this is not limited to the, let's say, European distribution basin, but also to other currencies and markets that since inception of this regulation and the promise for a high degree of clarity in this field have been looking at our bonds with increasing interest. So I must say that this year, for example, around 40% of the total that we issued in CABs and SABs was placed in currencies other than our core currencies, which are, of course, euro and US dollar. In fact, we are ourselves starting to classify our interlocutors on the banking and on the investor side for the first time using principles that are shared and pay a lot of attention, of course, to the attention that these interlocutors pay to the taxonomy regulation. So from that point of view, I would say that this growing awareness with regard to sustainability issues and to the necessity of more clarity for more impact in both finance and the economy are paying off, and they are recognized indeed, and our engagement in this area is increasingly recognized as a competitive edge by investors.
I think you have a sort of modest amount of Canadian dollar bond issuance. Do you have more plans in that area?
Well, this year we have, yes, indeed, issued 1.6 billion of bonds in this currency. Definitely, the interest of Canadian investors is growing for our product, especially because we are one of the few issuers to use to issue use of proceeds bonds that promise one thing, that the proceeds will be allocated only to new disbursements following issue date without refinancing of already existing disbursements. And we have also, in our approach, established practices that permit us to review eligibilities based on new information as it becomes available. So what we are providing investors with is not only, let's say, a picture of what, for example, the expected impact was when a loan was signed, but in the course of time, upon disbursement, we also clarify whether the project has developed in a different manner or whether new criteria have been established. This permits us to redefine the eligibility percentages and allocate on that basis from then on, which is particularly important at this place. So in terms of opportunity of issuance, of course, we would like to issue as much as possible in Canadian dollars. This year, this currency has been the fourth currency, I believe, in terms of our overall funding in these instruments. And I must say that the interest in this currency, similarly as in other currencies, has also developed more and more towards ESG investors. So we issue more of our use of proceeds bonds and maybe a little bit less of our conventional bonds in this currency, which is very promising, of course, for the area I am responsible for.
So over time, the space has evolved so that investors get more information about where their money's going and what impact it's having. But there's also, and I believe you're on record as saying, there's also in the broader sustainability financing space, there's also greenwashing, and there's also stuff that goes on that's less desirable. What has to happen to stamp that out and to make sure that investors get the information that they need to assess the quality or the impact of where their money's going?
Well, first of all, I think it's not just a question of, let's say, the negative connotation of the word greenwashing that one should consider. De facto, sustainable investment is a different, is a difficult, challenging subject because of lack of consensus around a number of issues and the different priorities that exist in different parts of the world, for example. So very clearly, as also highlighted by the G20 study and now working group on sustainable finance, it is important to establish a kind of a common language that permits the various market stakeholders to all clarify what their priorities lie, to make them accountable, and to compare them. So the issue that is here is an issue of comparability in the first place. In order to have comparability, of course, you must simplify, because what we're looking for is not just the best possible and probably inachievable set of definitions of technical nature of the sustainability of the economic activities, but rather a set of rules that permit markets to work better. And this is indeed the approach that has been taken, I think, with success in Europe, on board in Europe in this field. So what is needed is that people define a common language by agreeing on the core features of sustainability, by agreeing on core internationally comparable indicators that people can use effectively to make themselves monitorable by markets in their implementation of policies that all should converge, although on the basis of different paths, towards common objectives. So this is what needs to happen. And I would like to underline that the initiatives that the European Union and the EIB have been taking forward in their respective fields of activity have also been thought from the very beginning as initiatives that should foster cross-border capital flows. Starting in 2017, for example, we tried to clarify different approaches by comparing the common principles that the MDBs use to assemble their statistics on sustainable finance with the taxonomy of endorsed green bond project catalog that China had brought to fruition at the end of 2015. And now this work is being conducted, it's been taken forward by the European Union and by China in the context of the taxonomy working group of the International Platform on Sustainable Finance. What is important is to clarify and identify a standard neutral classification system that permits people to clarify the specific features of their standards with regard to those core features, to those characteristics, core aspects of sustainability, and using those indicators that people in the markets can compare.
We've got a minute left, but the EIB does a number of things, from supporting small businesses to larger sort of project finance. How has the demand side from borrowers changed as a result of the pandemic?
Well, clearly there has been also on the lending side a high degree of attention paid to social objectives. So it's not. So there has been a recognition. It's a kind of a knock-on effect that we can witness, going from capital markets and their attention to social bonds and sustainability bonds last year and this year, to also borrowers and lenders on the other side of our intermediary activity. The focus on healthcare services, for example, has been rekindled by the pandemic and has also extended, for example, in the context of our sustainability awareness bonds that are also allocated to healthcare services, to the policy objective of universal access to healthcare services. There was the recognition last year that it was necessary also to consider, in addition to the additional criteria, also criteria that would take into consideration situations of emergency, like the one that were witnessed in countries like Italy, for example, where normally no special, let's say, support from a supranational institution would be needed. So I would say two main recognition. One, that sustainability has a social dimension, also, of course, linked to a series of parameters that change with the change in climate and environmental environment, and the necessity also to develop a structured approach to these issues that are more difficult to quantify, but that equally require a common approach in order for markets to act in an appropriate manner and help the transition or the transformation of the economies on the sustainable path.
We'll have to leave it there. Mr. Ramani, thank you so much for joining us today. Thank
you, Derek. It was really a pleasure.
And I'm pleased to be joined today by Vincent Delisle. He is the head of liquid markets for CDPQ. It's one of the largest institutional managers in Canada and the largest in Quebec, with a total portfolio of more than $300 billion. And we're very glad to have you today. Welcome.
Glad to be here.
Maybe you could just start by giving the audience a bit of an overview of what you do, what falls under your responsibility at the most important pension fund in Quebec.
Absolutely. So as you just mentioned in the introduction, Caisse de dépôt has about $300 billion of assets under management, US dollars. So it's $400 billion in Canadian dollars. I am in charge of our fixed income strategies, fixed income portfolios, both public and private fixed income investments, as well as our public equity investments. In total, that's about 2/3 of the assets under management at the Caisse.
When we were discussing beforehand, you talked about your DNA as an investor being one of a focus on long-term quality companies. Can you just talk a little bit about that?
Absolutely. One of the main advantages for pension funds, and one that we feel very strongly about, is the advantage, the opportunity to be there for the long term. So as long-term investors, you're less sensitive to short-term moods in the market, short-term volatilities. And what we find is sticking to fundamental processes, looking at quality companies that are there for the long term, has some great benefits for our performance. It reduces volatility as well, so our clients are happy with that. And that's one of the pillars of our strategy at Caisse de dépôt.
Now, on the fixed income side, there's been almost a revolution in how you guys have managed that portfolio over a number of years, switching much more to private lending, and the public part of that portfolio has gotten much smaller. Can you tell us more about that? Walk us through that evolution and why it happened.
Well, yeah, you're right. You know, the fixed income portfolio evolved significantly 4 years ago, going from pretty much all public sovereigns in the book to more of an increased exposure to private credit. Private credit offers higher coupons. So in an environment where interest rates are moving lower, we find that this was a good evolution to embark on. We still have a significant size in sovereign bonds as well, provides liquidity, agility, enables us to tactically reorient our positioning. But the increase in private credit, that we're doing it through various fields as well. You know, real estate lending. We're doing it into emerging market sovereign debt, investment grade and high grade. The advantage of being around the table, dictating the terms of some of those deals also is quite appealing to us, and it's seen an increasing amount of exposure in our portfolio over the last since 2016.
It's also a space that's becoming more and more competitive as other large institutions jump into that. What are you seeing in the competitive landscape on private loans when you're competing for business? What's the competition level like at the moment?
The competition is pretty heavy. You know, we're living in we're all dealing with an environment where interest rates are very, very low. So the chase for yield, the hunt for yield is everywhere, not only in our fixed income portfolios, but a lot of competition. And you know, one of the things we mentioned that, you know, the first question you asked me, or the second question you asked me, you know, the quality aspect of why we'll want to lend or why we'll want to invest is something that we're reminded of right now, as there's competition for deals for lending with spreads near, you know, record lows as well. So it is a very highly competitive market right now. Other pension funds have similar strategies of going into the private market. So it's relationship. It's making sure we get access to tremendous opportunities, but also being disciplined and patient.
Let's talk about the macro environment, because in 18 months or so, we've gone from the great disruption of the pandemic to the sort of frenetic recovery that took place, that has created in credit almost at times euphoric conditions, or certainly very robust conditions. Where do you think we are in the cycle?
You're right. This crisis has been very peculiar in terms of what triggered it. A pandemic. It's also been quite abnormal when you look at the extent to which governments and central banks have stepped in to inject liquidity and make sure that the economy would survive the Great Disruption, as you said, but also recover. What we find is that we're seeing this cycle play out much faster than other rebounds from recession. Certainly, when you compare it to the 07, 08, 09 financial crisis, the recovery has been much more robust, very fast. And we find ourselves, a year, 12 to 15 months after the start of COVID at the spring of 2020. And we think the early cycle phase is starting to peak out, and we're starting to see some mid-cycle signs. Central banks are talking about their next steps, which will be normalizing monetary policy, whether it's the Bank of Canada or the Federal Reserve. The Bank of Canada already talking about tapering its QE strategy. The Fed about to head that way as well next year. And this is all happening in the context where valuations in equity markets, valuations in credit are at very lofty levels. And the pace of the recovery we expect will moderate in the next few months. So it's only been a year since this recession ended. It feels more mid-cycle than early cycle, in our opinion.
It's only been a year, but in some ways it feels like a lifetime. The last 18 months. So continuing on that theme, then central banks are starting to talk about the next step. What are the indicators or signals that you are watching most closely to gauge when they're going to stop talking and start taking some action that would could change the landscape for fixed income investors?
Yeah, well, we're taking our cue from what central banks are looking at right now. So I apologize for the answer, but when you look at the Bank of Canada, it seems like the playbook for the Bank of Canada to normalize monetary policy is hinged on similar factors from the past: the output gap, the inflation numbers. When you look south of the border in the U.S., the Federal Reserve is talking about making sure there's an inclusive recovery. And for us, that certainly means looking at the employment numbers. So the recovery's been uneven globally. The U.S. has been doing better than other regions. Canada's doing very well also. In our view, when employment levels are back to pre-pandemic levels, then the tone from central banks will certainly start to hinge on being more of a neutral stance. Key to that is how transitory are the inflation numbers. The big debate out there is we're looking at inflation data in the U.S. and Canada that none of us have seen in our lifetimes. Central banks believe this is transitory. If we're still talking about transitory a year from now, we could have some issues as to how quickly some central banks need to react. But the timing is still debatable. Obviously, the next step, less so. So you're going from emergency monetary policy that is looking less and less warranted. How will markets react when rates start to gradually move higher? As I said earlier, with valuations at already very steep levels, the risk of disappointment, which you typically see mid-cycle, the risk of disappointment is increasingly visible in our view.
Are you on team transitory when it comes to the inflation debate?
When you look at the effects on, yes, we are on team transitory. Team transitory doesn't necessarily mean rates stay at zero, however, and I think that's a very important caveat here. We don't need to go back to 1970 type inflation numbers for rates. When you look at the level of real interest rates right now, which are at record lows still, the risk of inflation numbers, bringing a more balanced view from central banks certainly points towards yields reverting a tad higher.
You mentioned a couple of times, lofty valuations. We see that in both equities and parts of the credit market. Certainly, the risk of disappointment. How is La Caisse positioning itself or trying to protect itself or manage its risk in light of those factors, those circumstances?
Yeah, well, keep in mind, mid-cycle doesn't mean the end of the cycle. It does, in our opinion, bring an environment where the risk-reward outlook is more balanced for risk assets. Riskier assets tend to shine and outperform the most coming off recessions in the early innings of rebound. So from our point of view, the metrics we look at, the indicators we look at, have been indicating in recent months a more balanced risk-reward outlook for credit, for cyclicals, for equities. We had a much more of a pro-risk positioning in our fixed income portfolios and our equity strategies in 2021. And since May and June, we have been slowly paring back our risk levels. So I'd say we're more neutral in terms of positioning currently, which would correlate and be according to our view of mid-cycle conditions.
If you had to look out 2 to 3 years on the fixed income side of the portfolio, where do you see most likely the case putting more resources, more brain power, more talent? Where do you see the growth?
Private credit is definitely, so as you alluded to in the introduction, private credit in our fixed income portfolio has grown from non-existent in 2016 to significant portion today. And that's still where we are looking to grow. And so we need manpower, brain power, including data in the way we run the portfolio as well. That's definitely one of the areas. Real assets and private credit on the fixed income side is where we're looking to increase our presence. We're patient. Valuations are somewhat of a challenge right now. The competition for deals is a challenge, but our objective, we know where we're heading, and that's more exposure to private credit, and that's definitely the area of growth for us at La Caisse.
Mm. We were speaking to your CEO, in fact, earlier today, and he talked about at some length about the importance of technology, both as an investment theme, but also in the way that you guys operate. And he spoke about needing different kinds of talent, skills, degrees within the investment group. There's a lot of change going on in the case. Can you just sort of speak to that, to the people side of portfolio management?
Yeah, absolutely. Technology is not only technology companies or stocks that you can put in the portfolio. They get all the attention, but technology, data science, and processes and the way one can construct a portfolio is definitely one area that we feel very, very fond of. And we see it having an impact in all of our strategies, not only in public markets, public bonds, but also co-investment monitoring in private equity, in infrastructure as well. So that means looking for skill set that complement what we've been doing well for a long time, mixing finance degrees with economics degrees, with math skills, with computer skills. Our DNA in finding quality companies, long-term approach, obviously caters to bottom-up fundamental analysis. We want now to integrate some quantitative, systematic tools that help us optimize the way we construct the portfolio. So technology is certainly one of the key areas of focus for our CEO, for myself, for the executive committee, for every employee here at the case. So it means, our hiring objectives and how we want to complement our investment processes.
Another focus for the fund is ESG, and I know they will be speaking more about new targets in the days ahead. It's sort of easy to think about ESG as, well, divest dirty industries, but of course it has to be a lot more than that. How does ESG work its way into your own evaluation of private credit deals, for example?
Yeah, well, you're right. ESG is not simply avoiding areas or companies that you don't want in the portfolios. It's taking a stand, accompanying companies that are that we're invested in helping them in the transition. So whether it's on the fixed income portfolio where we're analyzing lending money to a company or an industry, or it's on the equity side, we have criterias, we have filtering processes that help us identify if we're going to give a green light or a red light to an investment. But there's also the post-investment accompaniment of investments that we have already made, where we can help these companies through this transition. So it's environment, it's social, it's governance issues, and it's front and center for all the employees here at the case. And that's one area we can also use technology to assess, to monitor the investments that we're making, filtering processes as well, and keep track of where the improvements are, back tests how companies are doing, those that are showing improvements, are they performing better? So it's E, it's S, it's G, but it's also getting included in how we want our processes to evolve, whether it's credit or equities.
What's the biggest risk you think the markets are underrating right now?
Well, there's a lot of confidence in the market right now that interest rates will continuously be a tailwind. Low interest rates cater to loftier valuations, valuation multiples expanding, and that's really what we've seen pre-COVID and since the recovery last year. And the absence of normalization from monetary policy, the expectations that stimulus can continue forever, it is feeding into some complacency and overly optimistic level of inflows and expectations in the market. So I'd say the easy answer, the obvious answer is when interest rates stop being such a tailwind, that will certainly bring some more volatility in the markets right now.
Thank you so much for joining us. That was Vincent Delisle from the Caisse de dépôt et placement de Quebec.
Thanks for having me.
Thank you so much, Vincent Delisle, for sharing your insights with us today. And thanks to all of you for joining us on day one of the 9th annual Bloomberg Canadian Fixed Income Conference. We surely hope you enjoyed these discussions. Thanks again to all of our speakers and moderators for the program, and a huge thank you to our sponsor, National Bank of Canada, for helping us make today's event possible. To watch any part of this year's conference, you can return to this website at any time. The recordings will be live on the agenda section. For more financial and business news from Bloomberg's global newsroom, visit Bloomberg.com. And remember to follow us on Twitter, @business and @BloombergCA. Join us again tomorrow for day 2 of the 9th annual Canadian Fixed Income Conference, hosted by my colleague Amanda Lang, and featuring industry-focused panel discussions, talks on the movement to a more sustainable economy, and various approaches to ESG. And you won't want to miss the keynote interviews with the CEOs of Boralex, Lion Electric, Bombardier, WSP Global, Quebecor, and the chair of the Sustainable Finance Action Council of Canada. I'm looking forward to these great sessions, and we hope you are too. Goodbye for now.